Hyperliquid is processing over $30 billion in daily trading volume, capturing nearly 80% of the decentralized perps market and even out-earning entire blockchains in fees. That kind of growth has people asking a big question. Could this be the generational trade of the cycle? In 2017, it was Ethereum before the ICO boom. In 2021, it was Solana during the NFT wave. And in 2025, the case for Hyperliquid is hard to ignore. My name is Danilo, and today we're going to break down Hyperliquid. Not just the headlines and the predictions, but the fundamentals, the bull and the bear cases, and ultimately what it could mean for you as an investor. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. Hyperliquid's rise has been nothing short of staggering. Launched in 2023, it didn't just enter the decentralized perps market, it completely redefined it. In less than 2 years, Hyperliquid has gone from being the new kid on the block to handling over $30 billion in daily trading volume, capturing close to 80% of the decentralized perps market. For context, its closest competitors, dYdX and GMX, have slipped to less than 2% each. In a space where leaders can change in the blink of an eye, that kind of dominance is almost unheard of. But it isn't just perps where Hyperliquid has made the waves. The platform has quickly become one of the top venues for spot Bitcoin trading. On certain days, it has processed more Bitcoin spot volume than Coinbase and Bybit combined. Just recently, it hit a record $3.4 billion in spot trading in a single 24-hour stretch. That's not just a flex, that's a sign that traders, both retail and institutional, are choosing to route real liquidity through Hyperliquid instead of the old guard. Keep in mind, institutional money is starting to take notice as well. On-chain trackers reported a 125 million USDC deposit linked to Galaxy Digital, one of the most established names in the space. Dashboards now show Hyperliquid managing more than $6 billion in assets under management. And whether or not every dollar of that is sticky long term, it's clear that whales and funds aren't ignoring what's happening here. Big capital tends to move cautiously, so when it lands somewhere new this fast, it's worth paying attention to. The key reason Hyperliquid has been able to scale so aggressively comes down to performance. Unlike many DeFi exchanges that feel clunky or laggy, Hyperliquid built its own layer 1 known as Hypercore, with a SEC-style order book that delivers sub-second finality. Traders get the speed and the smoothness they expect from centralized exchanges like Binance, but without giving up custody of their assets. That combination of speed, liquidity, and self-custody is very powerful. It's the formula DeFi users have been waiting for since the collapse of FTX reminded everyone why trustless systems matter. All of this brings us to the real story here. Hyperliquid isn't just another exchange chasing volume. It's establishing itself as the infrastructure. When you start seeing billions in spot and perps, whales parking hundreds of millions on chain, and a purpose-built layer 1 handling it all with scale, you have to ask whether this is a short-term run of hype, or the foundation of something that could challenge centralized giants for years to come. So, why do so many people think Hyperliquid might be the trade of the cycle? It comes down to fundamentals that most other tokens in crypto simply don't have. The first point is revenue. Hyperliquid isn't just pushing huge trading volume, it's monetizing that activity at an incredible rate. Over the past 30 days, the exchange generated close to $100 million in fees. And to put that into perspective, that's more than many entire blockchains. In fact, Hyperliquid has recently accounted for about 35% of all blockchain fee revenue. This isn't theoretical value or TVL that can disappear overnight. These are real dollars flowing through the system. And those fees aren't just sitting idle, they're funneled directly into the Hyperliquid token, HYPE, through regular buybacks. That means the more people trade, the more consistent buy pressure the token sees. And in a market where most tokens have vague, quote, future utility, Hyperliquid has built one of the cleanest bridges between platform usage and token value. Traders generate fees, those fees buy HYPE, and holders benefit. That kind of feedback loop is rare in crypto, and it's one of the strongest arguments for long-term value. On top of that, liquidity is growing at a pace that's hard to ignore. Stablecoin supply on Hyperliquid has doubled this year, from around 2 billion to more than 4 billion. And that matters because stablecoins represent real money coming in, not just crypto capital moving from one chain to another. Billions of dollars in stablecoins flowing into Hyperliquid means billions in potential trading firepower, lending activity, and token demand. Then there's validation from some of the industry's biggest names. At a WebEx conference in Tokyo, BitMEX co-founder Arthur Hayes told an audience he believes Hype could see a 126 times upside in the next 3 years. Now, whether you agree with that number or not, it's hard to deny the signal that someone like Hayes, who helped pioneer crypto derivatives, sees Hyperliquid as one of the strongest bets in the space. Finally, you have to look at the bigger picture of how the market is shifting. Centralized exchanges like Binance and Bybit have dominated derivatives for years, but the tide has finally been turning. Every single month, decentralized perps are eating away at market share. Hyperliquid is not just benefiting from that trend because it's driving it. More than half of all decentralized perp trading is already happening on Hyperliquid. If that momentum continues, this isn't just a successful protocol. It could become the central hub for on-chain trading. So, when you put all these factors together, the fee dominance, the direct buyback mechanics, the flood of stablecoins, the institutional attention, and the structural tailwinds behind DEX adoption, you start to see why the bull case feels so strong. For believers, Hyperliquid isn't just another token to speculate on, it's a bet on the future of trading itself. Of course, no story in crypto is ever one-sided, and Hyperliquid has some real risks that investors can't afford to ignore. The biggest concern is in its reliance on buybacks. Right now, much of the demand for the Hype token comes directly from the fees that are recycled back into the market. Now, that works great when volumes are high, but crypto trading activity is notoriously cyclical. If volumes slow down, the buy pressure that props up the token can vanish almost overnight. And without that constant stream of revenue flowing into Hype, its value becomes far more difficult to sustain. Market dominance is yet another question mark. Yes, Hyperliquid has crushed competitors like dYdX and GMX, but if crypto has taught us anything, it's that leadership rarely lasts forever. Just 2 years ago, dYdX was considered the unbeatable leader in decentralized perps, while today, it holds a fraction of the market. If a new competitor emerges with stronger incentives, or if a centralized exchange decides to double down on on-chain derivatives, Hyperliquid's grip could weaken quickly. There's also the issue of how Hyperliquid is using its revenue. Rather than reinvesting profits into ecosystem growth, acquisitions, or developer incentives, the vast majority of earnings have been directed towards buybacks. Now, that's great for short-term token holders, but you have to wonder if it limits the long-term upside. Imagine if Amazon had used all of its early profits to buy back stock instead of building logistics networks and expanding its product line. It wouldn't be the trillion-dollar company it is today. Hyperliquid risks falling into that same trap if it doesn't balance rewarding holders with building for the future. Finally, you can't ignore the fragility that comes with concentrated leverage. On-chain trackers recently highlighted a whale opening a nearly $300 million ETH long at 6 times leverage on Hyperliquid. On one hand, that's a show of confidence in the platform. On the other, it's a reminder of how quickly things can unwind. If big leverage positions like that go south, it doesn't just hurt the trader. It ripples across the entire ecosystem, potentially draining liquidity and shaking confidence in the exchange itself. So, while the bull case for Hyperliquid is powerful, the risks are equally real. It's a platform built on massive trading activity, dominance in a fast-moving sector, and aggressive buybacks. If any of those pillars weaken, the whole structure looks a lot less secure. To really understand why Hyperliquid matters, you have to zoom out beyond the platform itself and look at the bigger story playing out in crypto. Ever since the collapse of FTX, trust in centralized exchanges has been shaken. Traders want the speed and the liquidity of a centralized exchange, but they also want the transparency and security of DeFi. Hyperliquid has stepped into the gap, and so far, it's done what no other decentralized exchange has been able to pull off: match the performance of a Binance-style platform while keeping everything on the chain. This is why people are calling Hyperliquid the quote AWS of liquidity. It's not just another venue to trade tokens, it's becoming infrastructure that other protocols and traders can build on top of. With billions in daily trading volume and sub-second finality on its custom Layer 1 hypercore, Hyperliquid is showing that DeFi doesn't have to compromise on speed or usability, and for traders, that's a game changer. At the same time, competition is heating up. Coinbase has already tried to launch its own perpetuals product, but if history tells us anything, it's that not every big name can capture new markets. Just like at Coinbase's NFT marketplace, despite the hype, it really never took off. If Coinbase struggles to compete in perps, Hyperliquid's lead might prove even harder to challenge. And this is where the narrative shifts. The real question isn't whether Hyperliquid can keep racking up eye-popping volume stats. It's whether this cycle will be remembered as the one where decentralized exchanges finally flip the story. In 2021, Solana became the breakout chain of the bull run. In 2025, Hyperliquid is positioning itself as the breakout exchange. The platform that proves DeFi can go head to head with centralized incumbents and win. So if you're thinking about this not just as the token play, but as a cycle defining bet, that's the lens to use. Hyperliquid represents more than just hype buybacks or stablecoin inflows. It's a chance to back the idea that the next chapter of crypto trading will be decentralized. At this point, the story of Hyperliquid becomes less about daily trading stats and more about how you, as an investor, frames the opportunity. Because Hyperliquid is no longer a small cap gamble that might 100x if it catches lightning in a bottle. It's already one of the biggest players in crypto. By some measures, it now stands alongside Ethereum, Solana, and BNB in terms of market size and activity. So, here's the lens to use. If you believe that decentralized exchanges will continue eating into centralized market share, then Hype is the cleanest way to place that bet. It's direct exposure to the idea that traders won't keep trusting Binance or Bybit forever, and that the future of crypto trading is on-chain. In that scenario, Hyperliquid could be the defining exchange of this cycle, and holding Hype might capture that upside. But on the flip side, the risks are just as real. Hyperliquid's tokenomics are powerful but heavily dependent on sustained trading volume. If market activity slows down, or competitors claw back market share, the buyback engine weakens. And because the token is already trading at a multi-billion-dollar valuation, there just isn't much of a cushion. If things go wrong, the downside could be sharp. That's why the takeaway isn't buy or don't buy. It's to think about Hyperliquid as a thematic bet. If you want exposure to the rise of decentralized exchanges, Hype gives you that. If you think centralized exchanges will hold on to their dominance, or you're worried about the fragility of buybacks, then it's a pass. The important part is seeing the opportunity for what it really is. Not just another hot token, but a chance to align with, or step aside from, one of the biggest narratives shaping this cycle. Hyperliquid's rise is undeniable. In just 2 years, it has gone from a new entrant to dominating decentralized perps, posting billions in daily volume and generating more revenue than entire blockchains. The fundamentals are strong, but so are the risks. For investors, this isn't just another token. It's a direct bet on whether decentralized exchanges can finally challenge the giants of crypto. If that shift plays out, Hyperliquid could be remembered as the trade of the cycle. And if it doesn't, the downside could be just as sharp. So, what do you think? Is Hyperliquid worth holding, or is it overhyped? Let me know down in the comments below. And if you found this breakdown helpful, don't forget to like, subscribe, and hit the bell so you never miss future crypto updates. Thanks for watching, and I'll see you in the next one.